Hello, everyone. Welcome to our webinar. Today, we are diving into a crucial topic that explores the intersection of finance and risk management. While at the start, it might not seem very apparent in the beginning, learning more about financing alternatives can greatly enhance the resilience of your financial risk management strategies. This is because it can empower organizations to not only secure the necessary capital, but it also can build robust financial safeguards for your future. Without further ado, I'm delighted to introduce our expert guest today, who is Tash Salas, who is also the presenter of this session. We are truly honored to have Tash with us today, and I hope you also find our insights and perspective from our vast experience in the industry as valuable as I do. So once again, thank you all for joining us today, and I will now step aside and leave the stage to Tash. So enjoy the webinar.
Thank you so much for that introduction, Aya. I'm really grateful for being here with you, with your community of risk managers. This is a very important topic, and I think it's going to be relevant for the next at least 2-3 years. And when I say relevant, I mean urgent. I am, as my title says, founder of Alternative Financing Organization, an organization that took me years to put together because it's powered by some of the most wealthy families in the world and some of the most sophisticated investors. So when you're dealing with those type of people, it's really hard for them to do anything public. So I created Alternative Financing Organization as a gateway to actually connect with them in a different level and receive their support. So I'm currently the Director of Business Development and Partnerships for a single family office. Just for clarification, a single family office is an investment group that manages the wealth of one single family, really wealthy family. And then we also collaborate with other really large investment groups. We invest in founder-led companies, reaching inflection point of growth, consolidation, exit, or special situations. So we own and have financed different businesses in a range of industries such as commercial real estate, manufacturing, logistics, service companies, waste and energy, telecommunications, you name it. Really, we have quite a large range of sectors and industries that we get involved. And we're always looking to help companies grow stronger so we can later on join their journey as their partners. We recently have a lot of our clients, partners, and even other lending partners reaching out to us looking for alternative money. And when this starts happening, you have to realize that we are in a particular economy these days. It's not what it used to be 10 years ago. And we have been dealing with several fundraising and financing challenges across all types of sectors, including mining, construction, logistics, energy, cannabis, manufacturing, financial services, you name it. So companies are coming to us looking for help to recapitalize, finance their business, and get them out of the difficulty that they're in right now. Those financing requirements might be just maybe like small bridge loans, so just trying to get them from A to B, or maybe a turnaround, maybe they're going public, or maybe they have significant acquisition needs. So these are the things that we're working on right now at my investing group. And by the way, anybody who wants to leave a comment or a question, feel free to do it in the comments or Q&A section. I'll be answering those later. Also, please, if you have any questions in the future, reach out to our channels on social media. Like you can find me as Tash Salas, or you can find the company's page as Alternative Financing on LinkedIn. And our email is support@alternativefinancing.org. And just hit me up. I'll be happy to answer any questions I can. So yes, so every day we see different challenges, and we're learning more about the current economy, and that the universe of possibilities of traditional finance is very much narrowing. Opportunities are going away. There is a lot of uncertainty in the market. Investors are not interested in equity partnerships, and lenders have stopped lending on the retail side. And this has dried up a lot of sectors. So it is a challenging market out there. Now, lending rates, as you probably know, are very high, but they're not the highest. And we still believe that they will go up. And I'll explain why. The current US Fed prime rate currently is 8.5. Before Biden, it was 3.5. So you can see there has been quite an increase in the metric. Now, for those that are not familiar with financial metrics, prime, is the base for, we're going to call it risk-free lending for the Fed. And usually from the Fed's rate, you go maybe 2 or 5 points up for retail lending. So currently, if we're talking about 5.8 for lenders, it's really about 11 to 13%. So we're in the 2-digit type of lending. It's very high. And so most businesses cannot really borrow money at that rate, which really makes us turn around to look at the alternatives that we have, not just in alternative financing, but also in creative financing. So let's go back to the rates a little bit. So the lending rate have gone up, which causes a lot more risk of default. And this is not just risk for the lender, which are usually banks, but it also causes a lot of risk for the business. Many of the business acquire and pile up loans now and before the pandemic with floating interest rates or short-term periods and balloon payments such as MCA loans. Now, MCA loans are not meant to be a long-term solution, are meant to be a short-term solution. But when your company hasn't been able to get out of that situation, you start just going into a downward spiral of debt, lack of financing, and then you look way less attractive to investors. So it is a real problem. I call it the MCA attack because we're seeing so many cases. And so it is really difficult for companies. Now, businesses have to generate at least 2x return in that loan to pay it back and then still make a modest return on their investment. And with a slowed down economy, it can represent a real challenge, if not an impossible one. Now, mortgage payments have almost doubled, putting a lot of pressure on companies struggling just to pay their leases, not even their payroll, right? And property owners are also under a lot of stress because the tenants are simply not paying. They just cannot afford it, right? So at the same time, tenants are struggling because downtowns or the regular economy is not fully back to work. And so all this is causing the banks, the smaller regional banks, significant pressure. Experts say that there's over 250 banks, small banks, that will fail in the next 4 years. That is very close to what we saw in 28. So we're definitely seeing a lot of changes in the market, changes that some generations have not really even experienced. So we need to ally with very seasoned experts in this field to get us out of this situation, because we have not seen situations like this in 18 years. That is something that the head of private debt from BlackRock said a few weeks ago. So they're excited, of course. It's the best time for them. But for Main Street businesses, this is a really, really hard time. So now, this problem is also scaring people. The problem with the banks is scaring people. So large depositors that have over $250,000, they're actually scared and getting their money out of these banks, right? So if you have a payroll account with a good mid-size manufacturing firm, a lot of labor is required, right? And you have your payroll account in one of these banks, a lot of people are actually moving their money out of these banks because they cannot risk not having their money. And even if the Fed decides to bail out these banks, which could happen, you still, as a business owner, you still don't have those weeks or months while the situation is figured out, right? So yes, there's a lot of people also getting their money out of their banks. And regional banks, of course, they're concerned about their equity needs, right? What are they going to need now or in the future? Because they don't know the quality of their assets in their book, which, by the way, their assets are 40% commercial real estate. And commercial real estate is suffering an adjustment of the market, specifically in office space, right? And this is not like 28 where, we were going to recover. These changes are fundamental in the organization of society. So most likely we will not see a comeback of commercial real estate in many years while we restructure socially. So experts say that the collapse of banks will be worse than 28 and with a lower recovery in the commercial sector. This is not me saying it. There's also institutional fear. As I said, banks are struggling. We saw two big banks being bailed this year. We saw Silicon Valley Bank and Credit Suisse. They have to be bailed out by their governments. And so the regulators are descending to these smaller banks and reviewing their equity, their assets. This is for safety, and also this is creating a lot more pressure to banks from regulators, right? So in fact, we cannot really count on the government bailing them out. So, there's a problem out there. People are really scared. Banks are not lending, they're closing their books. They don't want the pressure. And so at the end of the day, really the ones that are struggling the most are business owners, having to meet payroll, having to meet the rent every month. And so what are their options in this market, right? So for example, one of the most unconventional types of lending is factoring, which factoring actually is not a loan. This is a better known option because, mainly because of its aggressive marketing. It's very easy to underwrite, and it has a fast delivery. Now that's factoring. And as I said, that's not a loan. It's actually selling your invoices at a discount, usually for 70 to 85% of its value. And in some cases, you're still liable if your invoice is not paid and you owe the factoring company. Now, that's important to understand because this is very expensive. This is like an MCA loan where it's not a long-term solution. It is a solution if you are profitable, if you have invoices, but it's not for everyone, and it's definitely not a long-term solution. Now, this is like the most basic alternative financing that people find immediately that they can access easy. There's no need for collateral besides obviously the invoices or anything like that. So quite accessible. Now, what is happening in the market in terms of alternative financing? Well, we have private debt, which is really taking up to filling the gap for small businesses financing needs. These are ultra high net worth individuals, family offices, hedge fund, and private debt is booming in the US and Canada as well. Now, however, we have experts that are really calling for a big chaos in the next 12 to 24 months. So, private money is there. We have a situation where businesses will struggle very bad, like bankruptcies in the next 24 months. And we will see that the economy for small businesses and bankruptcies, they will grow a lot because they cannot refinance, and the cost of debt, like regular debt, is really, really high for them. But more specifically, they cannot even access debt right now, right? So all these has real practical consequences for small and medium-sized businesses, in particular, those that do not have sufficient equity to survive these storms. And you know what, like if you're running one of these businesses and you're managing what can you do, right? That's the real question that we're trying to solve here. If you are a business owner or a manager of a small business, what can you do? Well, rates are not coming down to a more manageable level than as they used to be. They have been artificially lower, and right now there are specific reasons why the government needs to keep them so high. This is not speculation. This is reality. This is like an analysis of what's going on in the US. One of the most important reasons to keep them that way, you might think it's to slow down the economy, but actually is to reposition where the capital will be spent and allocated. Now, how they do this and why they do this is, first, they need to fill in a lot of employments, a lot, especially in the manufacturing sector, semiconductor sector. So all the STEM careers are, I think we're missing like 2 million in like STEM careers and like 4 million in labor. It's ridiculous. It's insane. And so when you have interest rates that are lower, where money is very accessible, you're really promoting entrepreneurship, right? Owning businesses. And that's what the government wanted for a very long time. But now what they really want is to have employees. They want to disincentivize entrepreneurship and they want to incentivize employment, of course, in specific sectors. So how will they benefit those sectors that need to keep growing even though the interest rates are so high? Well, for those businesses that need to grow, and if you are familiar with CHIPS Act, they're declaring these sectors part of a national security emergency. So yes, the government is trying to reallocate this money into these companies in other ways that is not through interest rates. So they're giving billions and billions of billions to these businesses through different programs, because the programs will qualify specifically the companies that will propel that need for growth in the manufacturing economy in the US. So yes, they're not coming back. They're not going down. There's specific reasons for that. And this won't happen in the next 2-3 years. This need will continue to be here for at least 10 years. So we will see the interest rates staying high for a very long period of time. Now, broadly speaking, managers, business owners, they only have 2 real options. The first one, of course, and applies also to individuals and families, is to reduce your debt, or you can increase your cash flow, right? Those are like the only 2 options you have. Well, now, how you might go about it. To reduce your debt, if you're running a small business and your debt service is causing you problems, which currently is probably for everyone, if you have squeezed margins, squeezed operating margins, cash flow margins, as a result, you need to take a hard look at every possible strategy to reduce your debt. I want everybody to understand that we are in a different mindset right now when running a business. You might have to get rid of stuff. You might have to get rid of people. You are in a cut mentality. So you might sell something marginal, like something that you don't need for your business. It's always great to have that extra piece of real estate when times are good and money was effectively almost free. And if you were profitable, you were spitting out cash, right? So if you have that extra piece of real estate that you've been hanging on to, that's great capital gain there. Well, that's a great thing. Now it might be the best time to sell that piece of real estate if you can get a good price for it and the proceeds to pay down the existing debt. That is like the best thing you can do. That's one way. Maybe consider a sales leaseback on real estate or an expensive piece of equipment for manufacturing. Now, leaseback, it's a very straightforward concept, which means that you sell your asset, whether it's commercial real estate, or equipment, and then you lease it back. So this is virtually non-disruptive for your business, but it frees up cash where it wasn't there before, and it was just in like locked in an asset, right? Now, of course, these assets are usually those that, as I said before, they're not really meaningful for your core business. So let's say that you are, a manufacturing company and you have an office building. Well, the office building is not really going to change your manufacturing needs or your operations. However, they will free up cash to inject it in where you need it the most for your manufacturing business, right? So that's virtually how it works. You sell your facility, take that money, pay down your debt, and then you lease it back. And obviously, you want to make sure that the interest rate with that lease, it's very beneficial for you. All the terms in the lease back are very beneficial to you. That makes sense, right? So now what you can do also is don't buy more stuff with debt. Like try to avoid or stop completely buying stuff on your credit cards, and instead start paying down your credit cards. That is the best investment that you can possibly make right now. You will have a guaranteed return of a high really percentage just by paying interest on your credit cards and by stop carrying that much debt. That's another way to reduce your debt. And another one would be to raise equity, right? Now, as I said before, raising equity in this market, it is really, really hard, if not almost impossible, right? Now, small businesses often have owner managers, okay? So think about it this way: in a debt to equity ratio, if you have $1 million of working capital, and that's like your capitalization, right? That's how much money you have. Now, let's come up with a number. Let's say that you have a debt to equity ratio of 3-1. Well, there's a 3-1 where $750,000 of debt, and you would have $250,000 of equity. Okay, so your debt is 3-1, right? That's 4 parts. Now, if you raise more equity in that scenario and reduce your debt to equity ratio, let's say 2-2, right? So that would be half and half equity, half cash, and yet now you can reduce your debt. Now, equity makes you lose control, right? So when you raise equity, you lose control of your business. That might be the only alternative right now, right? Like, we understand that business owners want to keep control of the business, but in moments like these, that's where you have to decide if you are willing to take all the burden yourself and keep control of your company, or reduce that burden and raise equity, if that's a possibility for you, right? So it might be a good idea. It might be a bad idea for you. I don't know, but it's an option. So what other ways are to reduce your debt? Well, you can always sell your business, right? Sometimes as an entrepreneur, it's just time, to take off your chips off the table, and you can just sell your business. Now that sounds not that appealing, and also realistically is not that easy. Businesses take between 12 to 18 months to sell. So, we're in a crisis and we're going to be here for 24 months at least. So I don't know if that's, again, I don't know if that's a good option, bad option, but it's an option. Now, what this whole thing is about getting you into that mindset of cut expenses, cut debt, try to budget as much as you can, understand the needs of finance in your company. And that is a totally different mindset from what we have experienced in the last 10 to 12 years. I said 10 really because 12 is like COVID, and COVID was so strange. It was just like a phenomenon that hopefully we won't see in our lifetime again. But it changed things very drastically. But anyway, so in the last 10 years of business, we were in an environment where debt was pretty close to free but it was very, very affordable. So if you wanted to grow, you can just go out there and get traditional financing, and most likely you would have it. Again, the incentives of the government were in entrepreneurship, build businesses, generate businesses. Now is not, and it will not change for a while. So the idea of what we're doing at Alternative Financing is hopefully to help business owners realize their options, what their options are, not just for alternative financing, but also for creative financing. And if you don't know the difference, one is more, I'm going to call it like lending, on the lending side of things, borrowing, structuring debt. That's alternative financing. And creative financing is what a lot of people call loopholes. Loopholes of the law, which they're not loopholes. As I shared earlier, the government has different ways to allocate money, to have the flow of money towards what they're needed the most. So there are different programs, there are different tax incentives, there are there's just like a ton of government incentives right now for these companies. And there's a huge problem. There's a huge problem in the market with these incentives because, one, it's hard to access those programs. Like, it's hard to understand what those programs are and be on top of them when they come out. Then when they come out, we have very few, if almost none, specialists in the market that can help companies. So accessing these experts and trustworthy experts, it's also an expense for businesses. And if they could pay it, they would, but sometimes they don't even know where to go, where to ask. So it becomes more complicated for them to access the quality of advisors that they need. And then, of course, we have horrible market situations, which is those that take advantage of these programs, of these incentives to qualify people that usually don't qualify, or they don't qualify for that much, and they will still make money from the companies. So now companies are really scared to go to just any marketer or any specialist in those programs or in those tax incentives. So now they're shying away from accessing this type of creative financing. So in my opinion, that is one of the biggest problems that we have right now. A great example of that is the employee retention tax credit, which is a credit that it was part of CARES Act with Donald Trump. And, that was a great incentive. Those were great ideas. The program itself changed like 4 times. So it was really hard for advisors and business owners to stay on top of what was going on, also to understand what the rules were. And long story short, a few weeks ago, the IRS totally stopped the program. It wasn't supposed to stop now, but the IRS stopped the program and blamed the marketers because marketers were just doing their job, which is market. But there we have bad actors who qualified people that were not qualified to ask for this type of incentive. They still got their money. The people that were doing the claims, they still got their money. But now the IRS is going to come back with a business owner and say, hey, business owner, you didn't qualify for this much. You owe me back this amount of money. And guess what? They're on the hook for it. And the IRS will make sure that all the businesses that requested this money are now liable for it, because this is like billions of dollars, okay? Billions of dollars that can be reallocated to certain industries. I'm sure, because they will look at it in very like detailed way, I'm sure they will maybe forgive some that are not in the industries that they needed the most right now, but still, they want to make sure that the funds will be allocated to the company, even though that was not part of the program. But so things like this have happened and will continue to happen, right? So I want you to have a trusted source of due diligence for these programs, for these companies offering the solution, and where it's accessible to you. and affordable to access that information and service providers. So that is basically a little bit of what we do here at Alternative Financing Organization. But let's go back to the cut mindset. Now, in order for us to help you in many different ways, in all the ways that we possibly can, you as a business owner and your CFO or your CPA, you have to understand the needs of your company very well. You need to have a vision of where you're going. What's your strategy? Are you growing, consolidating, exiting? Are you under a special situation? Like, we need to understand all that, right? It's very different to finance a growth company than to finance a special situation. So now also you want to work with real experts. And real experts in this context, it might mean a couple different things, right? So let's say brokers. Okay, so brokers are not bad people. But brokers have a product, right? They have to push that product. They have to learn that product. They have to understand only that. And so they're going to try their best to understand the basic information of your company to see if you qualify for that type of loan, for that type of lending. That's a huge problem in this market, okay? When the economy is as bad as it is, or maybe not bad, but just like struggling and challenging and confusing, and all these things are happening at the same time, you need to have an entire picture of what's going on. Anyone who sells a product or a service, you must know that in order for you to realize if it's a suitable product or service for your client, you have to understand their situation, right? So forget about these vending machines where you input like your name, the company's name, how much you want, and they pair you up with like 30 lenders. Go ahead, figure it out, right? I cannot emphasize how horrible those processes are for the business owner, because they're not learning anything about your company, anything about your vision. They are pushing a product, maybe like an MCA loan, or maybe like factoring, or maybe a small bridge that they don't care, and they don't really know if you're able to pay it. And so they're not doing the discovery process correctly. Now, also, as I mentioned before, another problem is that because we have not really seen these scenarios before, most people will not know how to do the discovery and how to understand what are your needs and help you find them in a sophisticated market, right? They will find them hopefully with their brokers, and I call it the spaghetti game. Like, they'll throw stuff at the wall and see what sticks. But that's definitely not the people that you need to work in this market. In this cut mentality, they're going to help you understand what you need to cut. They're going to help you understand where you need to put and allocate some resources to then be able to get to the next level for maybe another type of loan, another type of financing. So those are real challenges that we are facing right now. Companies are struggling, banks are struggling, brokers are struggling, and then private capital is also struggling, and I'll tell you why. And this is where I think you'll be able to find the most benefit. So private capital is also trying to allocate their capital somewhere. With great companies, they want to finance companies, they want to buy companies, they want to partner with companies. But there's a problem. The problem is that private capital is more than private, right? It's very silent, it's very secret. And the nature of this capital is that they don't want to be found. They want to find their investments. They want to find their partners. So that is not really scalable, right? And scalability, it's a huge, huge, huge part of helping the economy. I'll give you an example that you'll understand better, so you understand what I mean by channels of distribution of money. With the PPP, another program of the US government, which was the Paycheck Protection Program, this was a loan, okay? ERC was a tax credit. PPP was a loan, okay? So the government doesn't have the infrastructure to generate loans like that, to underwrite loans like that. So they partner up with financial institutions that had not just the infrastructure, but also they have access already to the clients, right? And that was the fastest way to distribute that money. So the campaigns, the marketing campaigns were massive. Like everyone in the US should know what the PPP is because it was a massive campaign. And also they partner up with banks and other financial institutions. So all of their clients knew about PPP, right? They were helping you actually process the application for the PPP. Now, private money doesn't have that. Neither they have the desire or sometimes possibility to partner up with financial partners like banks or other lenders to allocate their money. In the first place, because it's too expensive. You know, that costs the government billions of dollars just to partner up with them. Actually, they say the PPP was one of the most inefficient loans in history. So, you know, the cost of doing that it's very expensive, and doing it in a short period of time, it's almost impossible. So what are the options for private capital to allocate the money? Well, really is to partner up with a handful of people and small companies that can silently but effectively help them allocate that money by bringing in the companies, doing some underwriting, and then passing them on to them so they can actually create this entire vision and perspective of the company to help them understand where their either alternative or creative financing is in their companies. So that's basically what alternative financing organization is. We are an organization that has partnered with private capital that now we're opening our doors for companies that are in the need for this capital, right? Now, the problem is that, of course, we're small and we cannot educate one by one. We don't have specific hundreds of people behind us doing underwriting and collecting documents and everything else. So our strategy to achieve that is to provide education, guidance, training for financial professionals and business owners so they can identify opportunities in their companies. And then they can also tell us in a specific way what they need so we can understand it. And then we will help them process the information, create a deal memo, and then find ways that they can actually optimize their entire situation. We are not pushing a loan, but if you qualify for a loan, we'll tell you, and we'll tell you which one you qualify for. We're really pushing creative financing because that will get you out of a bigger problem, of the problem that you currently have, without getting you into another problem, right? Or into a follow-up problem in the future. Now, of course, what we want is to eventually partner up with you. So our best interest is in giving you all the tools and our private strategies and tactics to access this financing so you can grow and you can grow resiliently. And as we started this webinar, resiliency is not just navigating through the challenging times, but actually coming out stronger. And that is really what we want at an alternative financing organization. Again, you can follow me on social media. You can email me at support@alternativefinancing.org. And you can also stay in touch, follow our free information, our series of webinars and masterclasses. And also you can access directly to what is the Capital Connector certification, which again, it's really like your entry to our world and to help your clients or to help your business. It's really affordable. I've spent hundreds of thousands of dollars building this network of private capital, convincing them that this is something that we should and could do. So if you're watching this webinar, if you're part of this global risk management community, which is an outstanding community for people in, building the main street businesses out there, not public companies, this is definitely for you. I want you to consider becoming an expert. I want you to consider helping your clients, building your network, accessing some of the most sophisticated capital in the world. But first, you have to get educated, sophisticated, and help me help you. That's basically what this whole thing is about. I hope you learn a lot. I hope you understand clearly what are the challenges out there, and then also what are the challenges to solve those challenges. And we can do it together. We can solve those challenges together. Thank you so much for your time. I don't take it lightly. I know it's our biggest asset. So thank you for spending 45 minutes with me in this call. We'll do it more often, but mainly let's have that mindset of cut mindset of understanding what your financial needs are, and then the education to identify where the opportunities are, and I'll give you the capital network. Thank you, everyone. Thank you, Eye. Thank you so much for your trust, for sharing with your community. This was a lovely time, lovely space. I don't see any questions, so I'll just stop right here. Just want to thank you again.
Thank you so much, Tash. Indeed, it was a very insightful conversation, insightful, information that you have shared. Indeed, I also don't see any questions for this edition, but looking forward to the next ones.
Likewise. Thank you, everyone.
For joining, everyone.
Well, I'll just start, as always, AJ, by thanking you and thanking Boris, the founder of Risk Management Community, for trying to keep providing value to the members of your community with the most updated information about the global market that affects companies. So one of those situations, as we all know, and I probably don't have to explain it, is the financial situation around the world. And for me specifically, it has always been very challenging to just see the environment that we live in as in the business scene in the US, and knowing that there is so much capital available, yet there is very few companies that are actually receiving that capital. So that's really how this entire journey started for me. I'm currently working with a family office, a single family office investment arm. They're based in New York. They're a very extraordinary, kind, and generous family. Their main strategies are on the acquisition side for businesses on land development. They also have special situations, and currently, like a lot of private families, are investing in financing or debt. And one of the things that really got my attention when I first started working with family offices 5 years ago was that even though, families have a lot of money, they didn't really quite have the best advisors. And of course, I'm generalizing here, but yes, in general terms, you can say that that industry of the ultra wealthy people is not as sophisticated as I would expect. And so I realized that money cannot always buy you access to information, to tactics, to strategy. And that's when I saw the opportunity to actually bring something different to the world. And that's when I started thinking about the alternative financing organization and how this organization was going to be the channel, a bridge between the capital available from private families. And again, we're talking about trillions of dollars, and the companies and like the real life businesses that need that money to continue operating. So I talk with the family, and private capital has several challenges, but one of them among the others is that they don't really want to be public. There is a reason why people want to remain behind the scenes when you have a certain level of wealth. I mean, even if you don't really, right? But especially when you have certain level of wealth for security reasons, for branding reasons, or personal reasons. So most families have a real challenge giving money because they cannot really find the companies that easy. So I said, okay, well, what if we could pool the resources from different families into one organization with a similar and agreed thesis, and we could actually be the powerhouse, the power force for these businesses without them getting directly to you, but actually having like a strategy and a structure in between. And that took me years. Everything that we're doing here, it's very timely, but it's just because we were really getting prepared to what we are now experiencing. And I think that has always been the key to success, just getting ahead of things before they happen. So when they do happen, you're ready to either capture the value or share that value with the market. So that's Alternative Financing Organization. I am the founder. I have the privilege, the honor of working along with some of the most successful families in the world. And I've earned their trust and their respect because of what I put out there in terms of education and the grind, of course, the hustle. It's always pretty cool, but they also have become more acceptance of a different business model because things are changing. So we need things that are more effective, more efficient, and of course that are really making a true difference, not just something else. So hopefully this is my gift to you, the financing organization. And now what we do and why we're different. Well, really, as I mentioned before, this is an organization backed and powered by private capital from some of the most successful families in the world. And private capital is actually very, very different than institutional capital or retail capital. And I'll just get into it in a minute. But private capital, the way we work is that we are a more holistic type of capital, right? I think in the lingo of the industry, we would be smart capital. Thank you, guys. Yes. So, I mean, smart because the ones that have the money have been there, done that, right? They've made a fortune running a business. So, and then they became investors. So private capital has many profiles, right? In this case, we play several of them, which makes us very unique when we approach scenarios, when we analyze deals, when we talk to our clients, how we introduce them to potential partners. All that process, it's completely different than, just like going with your average banker or something like that. We have the perspective that we are asset owners. We are also investors. We are also entrepreneurs. So all those hats gives us a more holistic approach to the deal and a more humanistic approach to the people. So we're not pushing a loan or a specific type of lending because we don't have to, which is, also another difference between your Main Street broker who, by the nature of the business, he might have a few different options for companies, but not as many as that person would like to, neither as many as a single person can actually process. So it takes decades just to learn what's available. And another thing that takes decades is to know how to apply it. And, I look pretty young, and I am. But that's why I have intellectual honesty. And I'm always looking to work with people that are better than myself. And in this moment in history, I think people in the lending scene that have been around for maybe the last 10 years, they haven't really seen what this type of economic environment is bringing. And I put this in the words of the director basically of the division of private debt from BlackRock. And he said like a few months ago that literally when they first created this division, which was 18 years ago, they were thinking about this moment. They were thinking about these scenarios that they're seeing right now, that they're so different and much more complex and time sensitive. So, going back to preparation, I mean, they started 18 years ago thinking, hoping that they would see these scenarios. So I did not start alternative financing 18 years ago, but I started it during COVID when I saw the whole environment. I mean, we all saw the entire world changing rapidly. And I was just thinking maybe 2-3 steps ahead, like, okay, debt, and then what? And it's not that hard just to see what's coming and why some things won't change very quickly. For example, interest rates, hyperinflation, like those things are not isolated government decisions, right? So clearly there is an agenda in terms of incentivizing certain industries, certain sectors, because one, those are the ones that keep the world moving, right? As we very well learned during COVID, supply chain is a pretty big deal. Manufacturing, logistics, it really keeps the world running. So most countries have an agenda to incentivize these industries, these sectors. And at least in the US, the government of President Biden has allocated over $52 billion just for the semiconductor industry right now. And so you can imagine how important the next few years will be for national security, for the global economy, and of course, in a micro level for our communities. So that's why we are a little different than the rest of the capital. We're more holistic. We have a different perspective. We have a different approach. And now I do want to talk a little bit about specifically which markets we serve better, because as a slightly more sophisticated advisor, we have to understand that companies are like people, right? And they don't always have the same problems based on their stage, like we with age, or their specific needs, geography, etc. Right? So we are best positioned to serve companies in the US. Anywhere in the US, there's basically no difference for us in terms of state regulations. So we can basically help all the country. Now, we don't really go outside of the US. We can actually with telecom. We normally do. We're pretty intense around the world with telecom. That's pretty much the only exception for us, at least. Now, the companies that we can best serve are really in the range of the middle market, which is specifically for us between $30 million to $120 million in annual revenue. I'll explain why them in a second. But we are also doing an exception because we understand that these are very challenging times. And our goal, our objective, our desire is to be able to help as many successful companies, founders, and their communities as we can. So we're going all the way to $5 million. So from $5 million to $120 million in annual revenue, we can definitely help. The reason why we're better positioned to serve middle market, it's because the strategies that you can implement are quite different, are significantly different. But there's a rule that the one that can do the most can definitely excel at doing the rest. So hopefully we can do that. Now, the reason why we don't go lower than 5 million, and again, we would love to, is because really there's, first of all, the competition is crazy. And there's definitely better people out there, you know, positioned to serve these businesses. Of course, we can always take a look at it. If it's a really, really special business, like, for example, I get like a lot of manufacturing with some sustainability impact or some very cool research and development. Like, we love that, especially with research and development, because all of a sudden you have these red numbers in your balance sheet, and the traditional investor or the traditional financier will not even take a look at why those red numbers are the way they are, when usually a lot of smaller companies are doing research and development and they have that expense there, but they don't know how to report it, right? So knowing how to share the story of your business, it's also part of what we will share with you, we will teach you, because you might have a great company, and I see this every time, but you don't really know how to present it. And unfortunately, we're filled with noise. So if you don't have the right presentation in the first few minutes, or at least in the first interaction, it's going to be really hard for the investor or financier to notice the potential of your company. And more often than not, they will just pass. So that's also another thing that makes us very different, because we really try to understand the situation, not just for the presentation. And it might sound like we're doing storytelling or some hippie thing like that. We're not. Understanding everything about your business, like especially the story of the founders, their financial situation, their options, right, gives us the perspective to understand with our tools, with our resources, our toolbox, what can we use to make your business more efficient, more effective, leaner, and reduce the cost, right? Now, there's many other companies out there also offering like some sort of cost reduction or whatever. But the reality is that, as I said before, and I'm going to keep saying because it's just the nature of the market. One, it's really hard to find sophisticated professionals. Two, it has taken me years to vet certain solutions that they offer me in the marketplace. And I do have the expertise. So for the average person doing this due diligence, it's pretty much impossible, right? Like, actually, I just read an article in Forbes maybe like 3 days ago that it was just talking specifically about how expensive it is for business owners to access information, sophisticated advisors, resources, tools. And the expense goes beyond money. It really goes first towards time, but more specifically towards expertise. And, you know, if you're a CPA, CFO, you're really good at what you do, like your numbers. But this is like a totally different area of finance. So you don't have, like, there's no reason why you should have to know these things. But you should learn a little bit more about them, because they're definitely fundamental part of what helps a business grow, right? Capital, access to capital. So we work very well with this type of partners, right? CPAs, CFOs, CIOs, chief investment officers. I know in the cybersecurity space, there's a lot of information officers. Okay, in this case is chief investment officers. And again, we take a simple approach, which is, let's understand what is the situation, what are the needs that you have in mind, what else can we think about, develop maybe like a strategy, or maybe start with a simple tactic or product or service to increase your cash flow. Now, another thing that I really, really like about how we approach things is that most people come to us looking for a loan, right? Some sort of financing. And I really like that, because it's very easy for the American person just to think that they understand financing, right? It's not complex. I don't have to explain to them what this means. So people come to us, but if we can avoid them, the interest, the problems, the cost of getting finance with a loan or semi-conventional financing, I'm more than happy to do so. And it has happened plenty of times where we implement some of our cash flow optimization strategies or revenue increasing strategies as well. And we're able to provide them with almost up to 80% in one situation. I would say from there, it just goes down to maybe 40% of what they're looking for in a loan within their companies. So this is actually quite fascinating because more often than not, the company actually has cash flow there, but they haven't actually tapped into it because they don't know how. So that's another thing that in my organization, I call creative financing. I mean, I didn't come up with the term by any means. I'm that smart, but yes, we have alternative financing, which are unconventional, but closer to more the institutional, semi-conventional type of lending. And then we have the creative financing, which is really going into the personal stuff or the creative stuff of the company, of the founders, the arrangements to actually increase your cash flow or profitability without having to increase your revenue. And I think that's fascinating. I think most people don't have it as clear, or they don't have this perspective. And I wish I can just share this with everyone. So they at least start wondering, what is that I have in my company that I haven't either, explore or tap into, or how do I get to that point? And if you want to know, of course, the next thing is taking action and learning where you can get it done. So, ask your CPA, and your CPA should ask me. Yes, so that is what exactly, what we do, and how we do it. It's different. We have some proprietary methods. I would say that a lot of people ask me, like, do you reduce the cost of insurance? I mean, we could, yes. We would most likely refer you to someone like that. Like, where we really, really shine is in the whole strategy for financing, and mainly two areas of creative financing, which are tax credits. Incredible opportunity. You must tap into it, especially now with the Biden administration. Most of the money that was previously allocated to keep interest rates lower, so more people have access to money and they started businesses, etc. Now it's allocated through tax credits. So they incentivize entrepreneurship for 10 years. Now, those businesses that prospered, now they need capital, and the way that the government is giving it to them is through tax credits, right? So the rest of the population don't have it. Interest rates are pretty high still. But you, because you have a business, I'll give it to you in a different format. So tax credits are an incredible, incredible way to tap into the money that is available. And this really drives me to another point, which is people should actually be thinking about tax strategies as less risky. Why? Because we have this bad idea that tax strategies are extremely complex and we're going to get audited, and we are not going to have things the right way, the right place. That should just go away right now. Because when you do it properly, when you follow the rules, when you do it with an expert, that is no longer the case. Like, if an audit, which is usually like 1% chance that it happens ever, worries you, then we should just take a look at everything that you've done and fix it. Depending on the stage of your company, it might make sense or it might not make sense. But in reality, tax credits are the most desirable way that the government wants to help you. Tax incentives as well. And these are not loopholes or black box strategies. it's just simply people don't read the law, you know, and they don't read it as often as they should because, of course, the tax regulation is one of the most changing regulations in the world because it's the way that governments incentivize or disincentivize certain actions. So keeping up with it, it's pretty hard. And if you live in America, you know, the tax code is massive. So nothing secret out there really. It's more so like access to that information has, again, cost of time, expertise, knowledge, and then of course doing the due diligence of the service providers. So it's definitely challenging, and I encourage everyone to, you know, ask questions, ask a lot of questions, find the person that you trust in this space, and ask them to help you understand more about your situation. What are your options available? There are a lot of really savvy professionals that do capital raising. That's not like, you don't want to work with them right now. I'll tell you why. I'm in the private capital, right? And so I hear, I'm very lucky. I'm in very specific circles, and I hear what's going on. Equity is pretty much dry right now. I mean, if you have a great project, you should totally go for it. If you have a great network that would support that project, you should totally go for it. But it's going to be very challenging. And probably I am I'm giving you an advice and I'm not following it myself because I'm actually fundraising for my own company right now. But the main difference probably between my audience and myself is that I've spent my entire life building a network, and the last 3 years to then raise capital for this company. I always tell people, when you have to start, when you think about fundraising, you have to start 2 or 3 years before, really, when you don't need the money. Because if you need it now, then you're not going to get it. But yeah, so don't hire people fundraising money if your company is already at a certain stage where it could benefit more from a loan or a type of structured financing. Get a CFO for sure to organize your paperwork, and then come to us. We can definitely help you understand your options. What else? I mean, really, that's pretty much everything I like to share for today. If there's any questions, I'd be happy to answer them. As I said before, we're mainly best positioned to serve US companies, real estate in the 30 million to $120 million range. If anybody wants to know more about our other strategies or how to build a relationship with other family offices, with other contacts that you have, if you have a great network and you just don't know how to monetize it and you want to stop collecting friends and start building your business, that's also a good reason to reach out. We're happy to share what I've learned over the years so we can be more of us doing business with family offices. There's so much money waiting on the sidelines for the right companies, for the right entrepreneurs, for the right partnerships. So I encourage everybody who's interested, who has a business or is a business consultant for these type of businesses, to build a relation with the capital. It's important. It's a huge difference between working with private capital and not. And if you are in the world and you don't live under a rock, you probably know that private capital in this moment of the economic situation that we have, it's fundamental. But still, it's not going to go to charity. It will not. It's just not going to happen. Neither I think we want to, because we have amazing value in the existing businesses, generating value for the world, the community, etc., that they just need some money. And I call it smart money. Well, the industry calls it smart money. I actually call it kind money, because we really care and we're not trying to get a commission in time one. We're trying to get a relationship in time 100. with you and with everybody around you. So that's the main difference with private capital, the other capital, working with brokers, etc. I hope that really helps. And if anybody wants to reach out to me, you can do it via LinkedIn. My LinkedIn is Tash Salas. You can also email me at support@alternativefinancing.org. I personally check the emails every 3 days. If there's something urgent, they will always let me know. So yeah, please feel free to contact me to explore your situation and see how we can help you. Thank you, Ejit. Thank you to the global risk management community. Thank you for the people watching this. I don't know what part of the world you're in, but I'm in California, so it's quite early for me. It's kind of cold. So I really appreciate people that are here, that attended, that are watching, and that are trying to just mitigate the risk for their companies or somebody else's company. It's a noble duty.
Thank you so much as well, Tash, in behalf of the Global Risk community and all our attendees that have participated today. As Tash said, feel free to please send away your questions to her mail, her LinkedIn, or to us through globalriskcommunity.com or through our email address. So thank you so much.
Thank you, Ayem. Thank you, everyone. Bye.
Thank you, everyone.